if you do business with LLCs and other kinds of entities, and they are your customers, and if you want security to make sure those agreements get paid, you usually want to get personal guarantees. And those need to be signed by both spouses in order to make that personal guarantee actually be collectible. 50%, timing of buyout, obviously that's going to be critical both for tax purposes and also you don't want it to be open-ended. You want to be able to say such and such a thing needs to happen within 60 days or it won't, and there wouldn't be anything you can do about it. You do want a timing to be specific. The 50% ownership issue is something that I run into a lot. In fact, I actually have 2 active cases right now where you go in either with your spouse or with your friend 50-50. Seems like the logical way to go. The problem with that is, and you may have already run into this, is that then there's nobody that has the majority vote. And so nobody really has control. You both have control, but you really have no control. Nobody has control over the outcome of any major decision that needs to be made. So you end up with either getting 100% agreement, which is very common in the beginning, or no agreement, which is very common when disputes arise. So there are a couple ways of handling that. Again, it needs to be thought out before the conflict arises. One is that you can put in a partnership or operating agreement that if there is a dispute, that it goes to mediation or it goes to arbitration, anything short of litigation, and that you agree on who's going to appoint the mediator, how long the period of time is going to be until you mediate, what happens if the mediation fails. You want all that spelled out so that everybody understands when there is a dispute exactly what's going to happen, and hopefully it'll be the least expensive thing that you can do. Mediation is probably the cheapest thing you can do. Texas buyout is it's a situation where you put in your buy-sell agreement or your operating agreement that if you want to buy your partner out or your co-owner out, you can make a particular offer, and if he rejects that, then he has to buy you out for the same offer.
Right.
And it's basically a way of keeping everybody honest,
And that's part of this idea. Once you are in business with somebody else and you have co-owners, absent an agreement otherwise, you really have no practical way out of the business.
Oh yeah,
and at least this mechanism provides a way out. You're in business with a co-owner, especially a 50% co-owner. What this allows for is you to make an offer to buy out that co-owner because, look, you just cannot be in business together anymore. And that co-owner can only then do one of 2 things. Either accept the offer and you're done, or reject the offer. But if they reject the offer, now they have to buy you out on the same terms and conditions. So regardless, you're not going to be in business together anymore, and one of you is going to get the business and one of you the value.
Well, yeah, and that's what's slick about it, is that it doesn't eliminate the value of what you've already put into the business. You're getting something out of it. You either have the business that you're operating, or you have the income that you've acquired by selling your share. Now, the last 2 are what you don't want. This is what happens if you don't have these agreements in place. And that is receivership and liquidation. These are both court-ordered solutions to the problem that you have by being in a situation where you have a partner and you can't work together anymore. A receivership is where the court appoints someone to come in and run the business for you. And you don't have any say about how this person runs the business, and you have to pay him. So, I mean, how's that for a bad deal? So that receiver can basically do whatever he or she wants to the business, and has the court's full approval on what's going on. That doesn't sound like a good deal at all. I mean, I'm sure you all think you can run the business better than somebody else can. And the last one, liquidation, that's what a court will do if somebody is unhappy and sues and says, I want this business to end, I want out, I've got no other way out, so court, you dissolve the business. And as you can imagine, the liquidation value of your business does not include goodwill. You look at the equipment that you've acquired, and that's all you're going to get out of your business. You're not going to have all those good customer contacts or any of that to fall back on when you retire. It's just going to end. And so most small businesses don't want to, if they're liquidated, you lose almost everything you put into it if it gets liquidated. So receivership and liquidation are just bad news.
But otherwise, where the small business unfortunately all too often ends up, if good agreements are not in place to deal with that conflict and conflict resolution among those co-owners. Well, what I want to move into and talk a little bit now are these actual business transfer techniques. And there's 4 or 5 that we'll touch on and at least talk about briefly. One is just a sale of the business to a third party. One is a sale to a family member or other insider, key employee of the business. And the use of family limited partnerships, S-corp recapitalizations, intentionally defective grantor trusts as mechanisms to transition the business to key employees or family members in a tax-advantaged way. So we'll talk a little bit about each one of these and how they might work. Now first, a sale to a third party. Right? If I had a third party available to buy my business, that's certainly the easiest thing to do. And one of the most effective ways for me to get out of the business, get the most and immediate cash for the business. I eliminate any family succession issues if I sell to a third party. I don't have to worry about, I've got active family members in the business. I've got other family members who are inactive in the business. How do I equalize things among them? I don't have to worry about any of these issues if I've got a third party to sell my business to. And it's the fastest way for me to get out of the business. I can sell the business for cash out, I'm done, things are great. Unfortunately, if you look at mergers and acquisitions over the last 6 years or so, sales to third parties are not easy to come by. M&A activity over the last 6 years fallen dramatically. While I may want to sell my business to a third party, there just is not that much of an opportunity to do so. So oftentimes, my best strategy, and sometimes the only strategy, is to try to transition that business to key employees who hopefully I've incentivized to keep around long enough to make that exit plan work, or to family members. Perhaps I've got kids that are active in the business and I want to transition it to. And there's a couple of ways that we can do that we'll talk about now. If I'm selling the business to a family member or a key insider, a key employee, in that case, do I want to maximize the value of the business or do I want to minimize the value of the business? Because what's the biggest problem as an owner I've typically got if I'm going to transfer the business to a family member or a key employee? My biggest problem is they don't ever have any money. Right? How am I going to sell my business to my children or to key employee who doesn't have any money? How can I structure it in a way that's going to work so that I can get out in the time frame that I want to when my buyer's got no cash? Well, it might be kind of counterintuitive, but when you think of selling a business to a family member or a key employee, sometimes it's better to value the business in a lower amount, to minimize the value of the business rather than maximize the value of the business. And in a second, we'll look at why that would be. And no, it's not really a trick question. And if we look at selling the business to a family member or a key employee for cash, right? Let's say we've got this Gulf Unlimited Corporation. It's got a fair market value of $1 million. And I want to sell that business to my son or to a key employee that I've groomed over the years to take over the business, and he's got no money. So how is he going to finance the purchase of that business, if not out of the cash flow of the business itself? Typically, that's going to be the case. So I'm the owner, I sell my business to my key employee for $1 million. My key employee gives me this promissory note, says he's going to pay me $1 million over X number of years for that business. Well, for him to get me that $1 million, right? If he's otherwise now at a 40% income tax bracket, that business has got to generate $1.7 million of income, of cash flow, to pay me the $1 million I want to sell it for. Now I'm going to get taxed again on the $1 million that I get paid for that business, right? Capital gains rate's much lower rate, but I'm still going to pay $200,000 on that $1 million. So the business has got to generate $1.7 million of cash flow to put $800,000 in my pocket. Right? Now that's if I value the business at $1 million and I sell it at $1 million. But what if I have an appraisal of that same business and I can defend a value of $300,000 rather than $1 million? Right? Well, now, for that business to pay me $300,000, it's only got to generate cash flow of $450,000. Right? Now the new owner generates $450,000 of cash flow, pays his income tax on that $450,000 of cash flow, and after taxes can now pay me the $300,000. I'm going to pay my income taxes again on the $300,000 I've been paid, but again at capital gains rates, which puts $240,000 in my pocket. Well, $240,000 is still sure a lot less than the $800,000 I got in the prior slide, but if I sell the business at that lower rate and then set up a mechanism for me as the owner to get that remaining, $835,000 that I need out of the business to ultimately put in my pocket the $800,000, and I could do that through different means. I could do it through a deferred compensation arrangement, where the company, years in advance, agrees to pay me X amount of dollars after I retire from the business. Right? I could do it in other ways, through consulting fees or services to the company. But I can do it in a way that is deductible at the company level as it comes out, and generates a tax only at one level rather than at both levels, and can put the same $800,000 in my pocket. If we look here at the two different methods that we just ran through, in the first method, you've got that business having to generate $1.7 million of cash flow to put the $800,000 in my pocket. In the second method, where we sold the business just for $300,000, and say set up that deferred compensation arrangement for the second $835,000, well, now we only need a total cash flow out of the business of $1,285,000 rather than $1.7 million to put the same $800,000 in my pocket. Now that excess between the $1.7 million and the $1.2 million, maybe I could put more in my pocket after that, or get paid out over a much shorter time frame than it otherwise would have taken if I sold it at the $1 million and the $1.7 million of cash flow was needed. So oftentimes, if I'm selling to a key insider or a family member, perhaps minimizing the value of the business rather than maximizing it, I can get the same dollars into my pocket in a tax-advantaged way. Let's talk for a minute about the use of family limited partnerships as a means to transfer and transition the family business to younger generations in particular. Right, a family limited partnership is just a state law entity that has a general partner and a limited partner, or general partner and multiple limited partners. But one of the things that I can do is create this family limited partnership, transfer the assets of my business to the family limited partnership in return for all of the ownership interests, both the general partner interest, which retains all of the control and decision making over the limited partnership, and I would get all of the limited partner interests. Now, if I have a C corporation, I could transfer that C corporation stock to the family limited partnership in exchange for all of that ownership in the limited partnership, the general partner interest, the limited partner interests. Cannot transfer ownership of an S corporation to the family limited partnership. And in a minute, we're going to talk about a little bit different structure that we can use for S corporations to essentially get the same effect. So, in the family limited partnership, I either transfer the assets of the business or the C corporation stock in return for that ownership. But what that then allows me to do is I can give away those limited partner interests in the FLP, in the family limited partnership, while retaining control of the business through continued holding of that general partner interest. And I can gift those limited partner interests to children, to grandchildren, perhaps to trusts for their benefit. And the advantage that I get in making that gifting is I can do it at a discount. And the reason I get a discount is lack of marketability and minority interests. And the idea behind that is, let's say I create this limited partnership and I'm the general partner holding 1% of the partnership through this general partner interest. And I own all 99% of the limited partner units. And I want to start transitioning my business to my children. Well, I can start gifting those limited partner interests. And let's say that the totality of what this limited partnership owns is $100. Right? If I gift a 1% limited partner interest in that limited partnership to my child, I mean, really what you think they would own is something that's worth $1. Right? If I've got 100 units in this general partnership, and it owns $100, each unit ought to be worth $1. In theory, that's true. In practice, it's not. And as a result, when I gift this 1% to my child, he really doesn't have $1's worth of value. What he has is 1% of a limited partnership that he can't do anything with. That 1% limited partner interest has no control rights, really has no voting rights. It can't control the business in any way. And it's not marketable. He can't sell it to anybody. Nobody's going to buy this 1% interest. So as a result, the IRS allows us to take a discount in that transfer. So when it comes for me to gift that ownership to my child or to my grandchildren or to trust for their benefit, I might get a discount of 30-35% of what I'm really gifting. So what that does is allow me to transition ownership to younger generations at a discount, at much less cost than it otherwise would be for me to hand that child $1 or $100 or $1,000. And in making those gifts, I can rely on a couple of different things. I can rely on this $13,000 per year annual exclusion I've got, where I can give up to $13,000 of value without eating into my gift or estate tax exemption at all. Or I can start using up some of my gift and estate tax exemption. And in fact, this year and next year might not be a bad idea to do that and transition value out of my estate for this reason. You know, under the current law, we've got a $5 million gift tax exemption. I can give away $5 million of value without triggering a gift tax. Now, I've got to use up my gift tax exemption to do that, which will also use up my estate tax exemption. But we don't know where that's going to go in the next few years. And if Congress does not otherwise change the law, when we get to the year 2013, that number is going to drop to $1 million. So for families with closely held businesses that have some value to them, this year and next year may be a very good time to use up some of that gift tax exemption and move substantial amounts of wealth out of our estate and into our children or grandchildren, or as I've mentioned before, maybe better yet, into trusts for their benefit. And now the cash flow from that business is also being diverted into those younger generations, which might be used to then buy additional ownership from me if I didn't want to continue the gifting program. So this family limited partnership allows me to transition ownership to younger generations while continuing to maintain control of the business and at a discount. So the advantages of using this kind of a technique, well, the discounting that we've talked about, the separation of ownership and control, where I can move ownership into younger generations, but not necessarily control. It allows me to consolidate management. What if I had multiple businesses that I wanted to transition into younger generations? Well, I could transfer those multiple businesses, hold them under the single umbrella of the family limited partnership, and allow me to transfer even more value to younger generations, but still consolidate management at myself through the use of that general partnership interest. Additional asset protection, right? Family limited partnerships, like corporations, are asset protected vehicles. So it may provide additional asset protection, and even more than I may otherwise have. If I own a C corporation, for example, right, I've got stock in this corporation, and I've got a creditor coming after me personally. Let's say I've killed somebody in a car accident and I get sued. Well, that creditor could foreclose on my stock ownership and essentially take my stock from me. He now owns the business. If instead I had contributed that stock to a family limited partnership, he can't get to that stock anymore, right? Because I don't own it. All I own is this interest in the family limited partnership. And in Arizona, at least, a creditor like that cannot foreclose and take my ownership of the family limited partnership. So I've got some additional asset protection going on there. Now, some of the disadvantages of the FLP idea is, now I've got another brand new entity that requires administration, right? I've got to file tax returns for it. I've got some administrative burden to this new entity. The general partner has got a fiduciary obligation to the limited partners, but that's really, you're not in any worse position than being a majority owner in a corporation with minority owners. You've still got a fiduciary obligation to those minority owners. And FLP planning, particularly at the level of gifting to younger generations, might generate some IRS scrutiny, but that really just gets to the valuation and the discounting that I'm using in making those gifts. If I'm too aggressive at the discounting level, that might invite some IRS scrutiny at what I'm doing. So this is basically how an FLP kind of idea works. The parents transfer ownership or assets to the family limited partnership, they take back the ownership, and then start making gifts to younger generations to transition the business there. The second issue I want to talk about, this S-Corp recapitalization, right? Because if I've got an S-Corporation, a way in which many of us do business, I cannot contribute that S-Corp stock to the family limited partnership. It is not a valid owner of S-Corporation stock. But I can just about get there doing this, a S-Corp recapitalization idea, right? If I own an S-Corporation, one of the disadvantages of owning an S-Corporation is I can only have one class of stock, meaning all stock in the company